Good afternoon to our distinguished panelists and members. My pleasure to welcome you to our training today. It's organized in conjunction with the Capital Market Solicitors Association. The NBA Institute of Continuing Legal Education is constantly at the cutting edge of providing continuing legal education for our colleagues. The first session started off last week and it was well embraced. It was interesting. We had over 2,000 registrants and it was quite stimulating. The response and feedback was indeed positive and amazing. The chairman would have loved to be here, Mr. Tobinna Erije, but he's very quite passionate about this session, simply as the effect of our continuing legal education on our practice cannot be overemphasized, which is why we go all the way to ensure that we bring the best of facilitators and the sessions which are enriching to our colleagues. Without much ado, it's my pleasure to welcome the Vice Chair for the Capital Market Solicitors, Ms. Simisola Eyisomi, as she takes over from here. Thank you very much, and I wish you all a very interesting session this afternoon. You're all welcome. Simi, you're muted.
Oh, thank you, Mabel. Thank you once again, Mabel, for that beautiful start off. It's a great pleasure that we welcome everybody to the second session of the CMSA's and the NBA's Institute of Continuing Legal Education's training on the capital market. And the training for this session is Mr. Ayodeji Oyetunde, and he'll be speaking today on the overview of the Nigerian debt capital market, legal issues and documentation of the debt capital market transactions. Mr. Oyetunde is a partner in the capital market and mergers acquisition practice at ALN, also known as ALN Nigeria, also known as ALOCO and Oyebode, and he provides advice to clients primarily on mergers and acquisitions, private equity, corporate restructurings, debt and equity capital markets, and competition law. He has advised on a significant number of complex commercial transactions and has also provided advice to numerous clients on various landmark transactions with a cumulative value in excess of $20 billion. Mr. Oyetunde is also recognized in leading legal directories, including the IFLR 1000, and where he is also ranked as a market leader. He is also consistently ranked by other leading legal directories, including the Legal 500, including Legal 500, Chambers Global, and where he has earned considerable praise for his expertise in mergers and acquisitions, as well as restructurings. He was recently recognized by Business Today as one of the top 10 corporate lawyers transforming commercial law in Nigeria. He has also been recognized by Who's Who Legal as a specialist for mergers and acquisition in Nigeria. He is also the recipient of the Client Choice Award in the M&A category for Nigeria in both 2022 and 2023. He is presently the chairman of the Capital Market Committee of the Nigerian Bar Association section on business law, and is also a member of the NBA and the Association of International Energy Negotiators. He is a SEC registered compliance officer and also a fellow of the Chartered Institute of Taxation in Nigeria. It's with great pleasure that we welcome you today, Mr. Oyetunde, to this session. We trust that it's going to be very enlightening. It's going to be very engaging. So we enjoin all participants that have signed in to pay rapt attention. So over to you, Mr. Oyetunde. Thank you very much.
Okay, thank you very much. Thank you for the kind introduction. What I'm going to do is I'm going to try and share screen in the next 20 seconds, and then we'll take it from there. I'm sharing my screen, just confirming that you can see it.
Yes, I can see it.
Okay, so I've gone to slideshow. I've gone to slideshow. Just need to get rid of this. So I've gone to slideshow. we're talking about debt capital markets today, DCM. I'm going to try as much as possible to try and make it slightly granular. So if you're someone that has done quite a few transactions, because we have different people on it, but we'll also make it slightly interactive, that from time to time, I'll try and look into the chat room to see if there are any questions, and then take further questions at the end. So moving on from the cover slide to the next slide. So this is essentially what we're going to be talking about today. Overview of the Nigerian debt capital market. The intention would be that even if you haven't done DCM transactions, that by the end of this session, you would, even if you're not an expert, you'll be able to speak authoritatively about it. So we'll do an introduction. We'll talk about bonds. What are bonds? What are the legal issues and documentation around bonds? The consideration that you consider in issuing bonds. So there are different kinds of bonds: corporate bonds, sovereign bonds. We'll talk about commercial paper. We'll talk about what is commercial paper, legal trends, documentation, and we'll also talk about private placement notes, essentially. So jumping right into it. So in terms of the DCM, and if you haven't done any capital market transactions, sometimes it can look like a big masquerade, that, oh, what are these guys talking about? DCM, or essentially debt capital market, like we like to call it. In the Nigerian market, you have the capital market. The capital market is, to answer it in tautology, is the market that you go and look for capital. So if you were doing a business, or you had a client that was looking for capital to fund their business, you would go to the capital market to look for capital, or to look for funding. Capital used in the sense of funding. You can have equity capital, and I know that someone has already done justice to that. You can have equity capital, or you can have debt capital. Now, in this session, we're going to be speaking about debt capital market, which is essentially a debt instrument. The way I always try and explain it when I'm in this sort of foray is to perhaps we take a few steps backwards, and we try and understand that in the first place, before we try and define what the debt capital market is, or we talk about the various sort of exotic transactions that you have in the debt capital market, we even try and understand what is the debt capital market, and why, and more importantly, why do we have the debt capital market? The debt capital market has evolved over several hundreds of years. The easiest way to think about is that you want to do, you need money for a particular project. Whether it's you want to buy a new car, you want to rent a house, you want to buy a house, you want to go on vacation, you want to send money to your junior brother or sister that wants to Japa, or even perhaps you want to travel abroad. So you need some form of funding. Now, you can go to a bank and you can go and ask them to give you funding. But even if you're able to get the funding, typically it's more expensive. If you approached, say, a Zenith Bank or a UBA, for instance, now, in addition to asking for maybe your great-grandfather's birth certificate, they might also charge you interest at about 30%. So you might feel that is high. They might ask for security, all sorts of things. Now, the way this market evolved, because you had people that wanted to do business, so you want to do buying and selling, you want to travel abroad, or you want to bring in containers from China. You don't want someone that is going to stress you and then charge you interest. So perhaps you approach other people of like minds. Maybe you approach family, or you approach friends, and you tell them, guys, in order to bring in this container, I need 50 million naira. They say approach a bank. The bank is asking, and by the time you finish paying the interest of the bank, you will have paid maybe about 90 or 100 million naira, which essentially means that your entire profit margin goes to the bank. And if anything goes wrong and you don't even make any profit, they take over your business. So you approach people that you're comfortable with, and people that are comfortable with you. And they perhaps, each of them perhaps gives you 2 million, 5 million. And over time, you raise that 50 million for a small interest, maybe 10% interest. That's essentially how the market evolved, because people found that it was easier and it was simpler to perhaps try and raise money from a variety of people, a large number of people, or a number of people, as opposed to trying to raise money from a single institution. So it's similar to what you have even in our local markets. You have what they call ajo, or whereby people essentially try and pull funds together to try and do business, as opposed to trying to borrow money from a fintech that, or if you default, they send money to both your lecturer, your teacher in primary school, etc. We sort of get the point. So that's how the market essentially evolved. Now, when we say DCM, the debt capital market, or when you talk about a corporate bond just means that a corporate entity. So think about a limited liability company trying to borrow money, but in this sense, not borrowing money from a bank, but they're borrowing money from a wide variety of people. That's essentially what we mean by when we are talking about a bond. Another thing that it's useful to note is that if somebody comes to you, so you've been saving for 2 years, someone comes to you and says that, oh, they would like you to give them a loan. Surely you would need, and I believe most of us on this call are lawyers, you would ask for some form of documentation. So typically you would have a bond certificate, or it might be a physical bond certificate or an electronic bond certificate, but essentially something that would say that, oh, you know what, you've saved money for 2 years, instead of going to use that money to change your car or perhaps to buy your first car, you give that money to someone, and in exchange for that, you have a bond certificate that essentially shows that, oh, you are holding those funds. I won't necessarily go, because we're going to speak about bonds first. That's why I've taken time to start going into this. I won't go into commercial paper or any of the other issuance, any of the other types of debt capital market instruments at this point in time. But we'll come to each one of this. And if you have any questions, please and make a chat in the chat room. And also, I'm sure that towards the end of this, we'll also have an opportunity to speak, to ask questions. Now, moving to the next slide. Remember, we were talking about bonds, and I've already started explaining exactly what a bond is. A bond is essentially a situation where it's a debt security. So think about a situation whereby, let's look at practical instances. You've been saving money, you've been a lawyer for the last 3, 4, 5 years, and you've been saving money, and you've managed to save maybe 2 million naira to 3 million naira. But you put that money in a fixed deposit. The bank gives you maybe 3% interest. Then you hear that, let's assume we all have mobile phones. So let's assume maybe you use MTN. You hear that, MTN is doing a bond issuance. And for that bond issuance, it's at 15%. Now you look at it and you're like, look, the chances that MTN is going to run away with my 2 million naira is slightly slim. So you go online, you read the documentation, and you essentially lend MTN that 2 million naira. Now, MTN is not looking for only 2 million naira. Maybe, let's assume they are looking for 100 billion naira. But the advantage of them coming to the debt capital market is that they can actually now come to the market. So think of it almost intuitively, like you go to the market, you get a loud megaphone, and you say, guys, who is ready to loan me money? This is who I am. So you take your money to an MTN, and MTN then talks to different people. So some people provide them 10 million, some people provide them 100 million, but essentially they aggregate those funds. Now, when MTN aggregates those funds, and I'm getting slightly ahead of it, but I wanted to just bet this point. When they then aggregate those funds, you understand, they aggregate it. Someone gives them 500, someone gives them 100,000. They aggregate those funds. They would have a register of members, or a register of bondholders that shows that, Mr. XYZ, legal barrister XYZ, gave us the sum of 2 million naira on the 5th of December 2023, and they aggregate those funds, and they ask for your bank account details, and they then say, okay, our bond is for a 3-year period, and we're going to be paying interest on a quarterly basis. So they calculate that, they have your bank account details, and each quarter they pay the interest together with the relevant amount of principal that is due at that point in time. If you understand this explanation, and I've tried to simplify it, you essentially know what a bond is. every other thing that we're going to speak about is just layers on that. But as much as possible, the most important thing is that you must understand that you have someone called an issuer. You're in our scenario, your issuer is an MTN. So, or it may be a Zenith, it may be the federal government of Nigeria, but essentially the technical term that is used for them is that they're an issuer. So the issuer has come to the market and the issuer has decided that they want to raise maybe 5 or 10 or 50 or 100 billion naira for whatever reason that they want to raise it. Now, obviously, because we are lawyers, you would ask for documentation, and we'll talk about the sort of documents that if an MTN or a Zenith Bank or an Airtel or a GTB is coming to you and wants to take money off you, the sort of documentation that they will provide to you, just so that you're ultimately comfortable. But once again, the most important thing, and for an MTN perspective, you may ask that, oh, but MTN is a big company. If MTN wants to borrow money, why is it that it's my 2 million naira that they want to borrow? There are a number of reasons for that. We'll speak about that in the next couple of slides. But one of the most important reasons for that is that the debt capital market is ultimately much cheaper than your traditional loan. And this is the same in every jurisdiction on earth. You find out that by the time you have an issuer that is coming to the market, they're able to raise funding. So if, for instance, now a typical Nigerian bank would borrow you money at maybe about 30%, give or take, and we'll talk about in a few slides, we'll talk about why the cost of funding is so high, because I'm sure if you've ever tried to borrow money, sometimes you ask and you're like, these bankers, they just these bankers, they're just so difficult. And we'll talk about some of those reasons. Now, if a bank is going to be borrowing, let's assume I went to a bank, maybe they'll borrow me at 32%. So maybe it's an MTN, they have a better credit rating, they're a bigger company, they have a better corporate status. But ultimately, let's assume they're able to shave off 6 or 7 or 8 percentage points. That means that if they were going to a bank today and they wanted to borrow that same money, maybe they will be able to get those funds at 21 or 22%. Now, if they are going to come to the debt capital market, what you will find out is that they're able to borrow at maybe 15 or 16%. So you have a difference of 6 or 7 percentage points. Now, that may not look like a lot, but when you're borrowing 100 billion naira, so if you're borrowing, if you're good in math, if you're borrowing 100 million naira, 6% of 100 billion naira is already 6 billion. And if you're borrowing it over 3 years, that already means that, or 4 or 5 years, you can sort of do the maths and see that, look, it's ultimately more cheaper for them to sort of come to this market. I've just tried to just explain it, and I've jumped over about 2 or 3 slides, but we would address this slide specifically. I think I've sort of dealt with the introduction. Now, in terms of bonds, they're different. Typically, what will happen is that if you're issuing a bond, typically an individual such as myself will not be able to issue a bond. It will always be a corporate entity. So when we say corporate, it might be a company that is registered with the CAC that wants to issue a bond. When a company is issuing a bond, we call it corporate bonds. Now, you can have corporate bonds. You can also have government bonds. Now, if the federal government, and the federal government of Nigeria is one of the most active players in the bond market. So when the federal government of Nigeria is issuing a bond, we call it a sovereign bond. Sovereign just means that they're sovereign. If a state government is issuing a bond, we call it a subnational bond, which is why you sort of see, or a state bond or a subnational bond. Sub just means that, oh, it's one layer below the federal government of Nigeria. Now, other things that you can have you have different types of bonds, and I'll try and start delving into the presentation. I'm conscious of time, and I want us to have time for questions at the end. So you can have a fixed rate bond. A fixed rate bond is the easiest type of bond to understand, because it just means that, look, let's go back to our scenario. MTN wants to raise 100 billion naira. You have 2 million that you're willing to lend MTN, and you're like, guys, when I buy credit from you, there's no story. If I'm going to give you my 2 million naira, there cannot be any story. What's the interest rate? They tell you, oh, your interest rate is 15%. So that means fixed rate bond. You can have a floating rate bond. A floating rate just means that the interest rate floats. So the interest rate the Central Bank of Nigeria has something that they call MPR. That's the monetary policy rate. It's essentially, and in an ideal world, interest rates of banks are meant to track the monetary policy rate. So they can say that, oh, the monetary policy rate plus 2%. Essentially, you sort of see where I'm going. You can have zero coupon bonds. I won't necessarily go into this. Someone may ask, what's zero? Zero coupon just means that essentially the interest is already built. The interest is already built into it. So what will happen is that instead of MTN taking 2 million naira from you, they calculate the interest. They say over 3 years, your interest is going to be 450,000 naira. So they only take 1.65 million naira from you, and they give you a bond certificate for 2 million naira. And at the end of the 3 years, they give you they pay you 2 million naira. So that just means that effectively you're during the life of the instrument, you're not they're not paying any interest to you. I won't necessarily go into green bonds, but just think about is that there are bonds that are for social projects. I won't go too much into that. You can have sukuk bonds, and we have all kinds of Sharia compliant product. There's an entire school of thought on Islamic finance and Sharia compliant products, and we can spend 5 or 6 hours talking about that. But just to flag that for your Sharia compliant bond, it's similar, but there's slight differences, and I don't want us to get distracted, so I won't go into that. You can have convertible bonds, which just means that the bonds are maybe convertible into equity. So right now, let's use MTN again. MTN is listed on the floor of the Nigerian of NGX, or what used to be known as the Nigerian Stock Exchange. So for your 2 million naira, it might have a convertibility option, which means that look, if at the end of a certain period you may decide that, you know what, I really like this company, they're really paying me interest, I don't want my principal back. I want my principal to be converted into shares of the company or into something else. Or you can also have what is known as a Eurobond. A Eurobond is essentially if you're trying to issue an instrument in another currency. So obviously, most of us are in Nigeria, I believe, and we all spend naira. But if you wanted to issue a bond, maybe in dollars, that's a Eurobond, and there's a market for that. There's a market for that whereby the federal government issues Eurobonds, and they've done a number of issuances whereby they go to the market, they try and raise $5 billion or those sort of amounts. So I think we spent time on this slide, and I'll try and move slightly faster. Now, in terms of pros and cons of bonds, we've already started talking about this. The most important thing you need to understand is that, look, the cost is significantly less. Number one, the cost is significantly less. And number two, because you're issuing to a wide variety of issuers. So if I borrowed money, say from, I think I've used Zenith and UBA. So if I borrowed money from First Bank, for instance, now, if, for instance, somebody felt that I wasn't credit worthy, it's very easy for them to call the loan, or to even try and enforce security over the loan. If I've given security over the loan, there's a lot more flexibility. If you're talking to bonds, thing is this easy, let all of us do it. But what you need to bear in mind is that not everybody, remember I said that individuals don't issue bonds, and even it's not every corporate entity that will be able to issue a bond. You need to have a certain credit rating. Remember, we used the example of an MTN. So it can't be a company that is just selling pure water down the road, because if a company that was selling pure water down your house or down the road from you wanted to raise money, you might not necessarily be that willing to give them money you've been saving for the last 4 or 5 years. So it's not every issuer that can access that market. That market. We talk about operational freedom. There's more control over the funding process. There's also liquidity. Liquidity just means that at the point that the bonds are issued, let's go back to our scenario again. So you have an issuer, MTN on one hand. You have me, a brand new lawyer, working for 2 or 3 years with my 2 million naira that I've saved home and abroad. Now I give that money to MTN, and they give me a bond certificate. You can have a physical bond certificate or an electronic bond certificate. Now, there's a process whereby after MTN has raised the money, they then go and list the bond on an exchange. On an exchange. So they go and, so similar to the way shares are listed, they go and list the bonds on maybe FMDQ on NGX. Now, what that then means is that if I decide I don't want to wait for 3 years, I can actually then tell my stockbroker or a broker acting on my behalf that, all right, please, I have this instrument. Can you please sell this instrument for me? Because I would like to get married next month and I need this money very urgently. And I can't wait for 3 years to get married. So that means that there's liquidity in the product. We've already spoken about the greater universe of investors. You understand? One thing to just notice that depending on the nature of the instrument, it's not everybody that will be able to invest in the instrument. But essentially, you have a greater universe of investors. So it's not just one bank. It can be thousands, tens of thousands of people that they're structuring products for. Another very important thing to also talk about is that another huge advantage that bonds have over traditional loans is that because of the nature of our economy, it's extremely difficult to see a Nigerian bank that will be willing to give you a loan for 5 years. It's even more difficult to see a bank that will give you a loan for 10 years. But the federal government of Nigeria has actually issued instruments for 20 or 30 years. So with a bond instrument, you have much longer tenures. Now, what that does is that imagine if you were trying to raise, say, 100 billion naira, and let's assume I wanted to raise it, but that those funds are being raised for a particular project. It's going to take 2 or 3 years to actually do the project. And then over the course of the life of that project, I will repay, and it might take me maybe 7 years to repay. It's a situation where I show up at a bank the moment I show up, they start looking at single obligor limit, my credit rating, can I read this, can I repay, what are the chances that I will default? Is slightly different from an issuer that has a longer tenure. Remember that I said that it's also important to know that not everybody has access to this market. You need to have a certain credit, let me use the word, not credit rate, a certain credit standing. So it has to be someone that we would all ultimately be comfortable with. You understand? So typically it will be a medium to large scale institution. So think about maybe an Access Bank or a Zenith Bank or an MTN or a share corporation. Those sort of entities that just by mentioning their names, they're people that all of us are all sort of familiar with. Now, in terms of the cons of it, it requires timing. It requires a bit of time because it's a more formal process. So typically for your corporate bond issuance, you will need to get a certain level of regulatory approval. You need to go to the SEC to get approval. Between when they start the process and then they need to appoint a certain number of advisors, and we have a slide on that, by a certain number of advisors. So between when they appoint the advisor and when they actually get the money, sometimes it may take maybe 5 or 6 months to actually get it. So timing might be an issue. There's also, I'm not sure this is a disadvantage, but there's also a bit more public visibility because of the nature of investors that it's directed towards. And I've spoken about credit rating or credit standing as well. Now, we've already started talking about the legal issues, around the bond issuance process. So we've spoken about the fact that it's a more formal process. So instead of so if I wanted to borrow money from a bank, there are even instances that if you want to borrow money from a bank these days, depending on how much and how long you've been banking with them, you can actually just go on your bank's app. And sometimes they're ready to borrow you, maybe it's 100,000 naira, and the interest rate might be crazy. Let's leave that aside, but you can actually get money as opposed to a situation whereby you want to borrow money, you need to go to a regulator, you need to go to the SEC, you need to you need to appoint advisors, you need to list the bond on FMDQ. So it's a much more formal process, but also the advantage that you also remember is that on the flip side, it's also important to understand that this market is not for everyone, number one. Two, it's typically for people that are raising fairly significant amounts of money. So typically, at the very minimum, if you're doing a bond issuance, you're trying to raise a couple of billion naira at the very minimum. And another thing to also bear in mind is that because those issuers have a certain credit standing, they're able to get away with it. And remember that we've also spoken about the fact that your bond issuance is actually significantly cheaper than your traditional loan. So even if I was able to get a bank that would borrow me, that would lend me 1 billion naira, let's assume I had a company And if they were willing to borrow me 1 billion naira, say 25%, 25% interest rate per annum, that means that that means each year I'll be paying 25%. 25% of 1 billion is 250 million naira. So just sort of think about it that, look, I'm borrowing 1 billion over a 5-year period. Let's assume that the amount remains constant. Obviously, I'll pay down, I'll be paying down principal, but in the first year, I'll probably pay maybe about 200 million naira. The following year, I'll pay again. So if the principal remain the same, and the principal will not remain the same, I totally agree with anyone that is raising that point. But if the principal remain the same at 25%, that means that for that 5-year period, I'll be paying 250 million naira times 5. Now, remember, I'm borrowing 1 billion naira at 25%. By the time I finish paying that, at the end of 4 years, I've actually paid that 1 billion. At the end of 5 years, I've paid more than the 1 billion. But in the real world, what will happen is that as I'm paying interest, I'm paying down the principal, so that the interest I actually pay would be less than that, as opposed to a situation whereby I'm able to come to the market and I'm able to get away with maybe a 15, well, not get away with it, but I'm able to raise capital at 15 or 16%. It's still a lot of money, but that my 1 billion naira, I'm only paying 150 million naira as interest instead of 250 million naira. So if you can already see that even in the first year, there's a differential of 100 million. It's because of that 100 million naira differential, and that 100 million naira differential over a period of 5 years. So if principal remain the same, you're saying between 400 and 500 million naira in terms of what I would have to pay as interest. So if I was a businessman, as a smart businessman, and I'm sure that many of us were sophisticated people, if you are put in that scenario, you understand exactly why people take the trouble and go through the additional stress of going through the bond issuance route. Now, we've spoken about the fact that it's a formal process. Now, there are different ways you can try and raise, try and do your bond issuance. Now, we have a slide at the end that talks about a private note issuance or a private bond issuance. But in this sense, we're essentially talking about trying to raise funding publicly. So now, if you remember your CAMA, it's only public companies that can issue securities to the company. I think it's still Section 22 of CAMA 2020. So it's only public companies that can issue securities to the public. So what that then means is that it's a lot of times it's only a public company that can access that market. Now there are certain instances whereby you have a private company that wants to access that market. What they then do is that they go and register a subsidiary that is a public company that will then act as the issuer of the bond. But that subsidiary is then taking the benefit of the credit rating of the parent company. And in a lot of instances, the parent company would even guarantee the issuance of the bond. Last bullet point is just to flag that when you're issuing your bond, you can have what is known as a bond issuance program. So it might be that, you know what, I would like to raise money, so I establish a program. A program is just a big word that, look, I was going to say a program is a program, but it's just a big word that, look, I have a shelf registration. So that means that maybe I register a shelf program that says that I would like to raise 20 billion naira with the SEC. What that then means is that as long as I'm within the validity period of that shelf registration, I can issue securities fairly more easily, as opposed to, I raised 5 billion today, I want to raise 5 billion in 18 months' time. I go through exactly the same stress. You understand? Once I establish the program, it's then easier to then issue, to do issuances under that program within a fairly short period of time. We've started talking about this, and one thing to note is that a lot of issuances are directed towards pension funds because they are the largest single pool of funds in the Nigerian market. So I think last time they said they were holding about 16 billion naira of liquid assets. So a lot of these instruments are directed towards them, and someone may ask that, why would a pension fund want to invest in a bond? The reason is that if they put in fixed deposit, depending on when they put it, sometimes you put money in fixed deposit, maybe they're getting sometimes 4, 5, 6% interest rate, as opposed to being able to give the money maybe to an MTN and they get a 15% interest rate. So that's the reason. I'll try and quickly run through this. But one thing just to bear in mind is that, like anything, there's withholding tax that you might have to pay on the interest. But whether you put the money in a bank, so even if you have money in a bank, in the bank, when they pay you interest, they will still charge you withholding tax on it. Okay. So I've spoken about, I'm trying to keep an eye on the time, because there's quite a bit to talk about, and I want to create room for questions. So we've already started talking about the number of parties that you need to. So there are several parties that you would appoint. And an MTN or whoever is the issuer, they need to appoint an issuing house. So an issuing house is just an investment bank that assist them to midwife the process. So they're responsible for getting SEC approval. You have something known as a prospectus. They're primarily responsible for the prospectus. You have someone known as a trustee. Now, remember that we spoke about the fact that when you're doing a bond issuance, you're not targeting it to one person. In many instances, it might even be to thousands of people. Now, it's not practical every time you want to do something to go to each one of those people. So a trustee is appointed on behalf of the bondholders, and a trustee is appointed on behalf of the bondholders. It's the responsibility of the trustee to see that, they've done this issuance. Has interest been paid on time? Or are there funds in the account to pay interest? Has everybody been paid interest? For instance, has everybody been paid their principal? If there's an issue and the issuer has defaulted on something, is a trustee that will look at it. If you need to call a meeting of bondholders, even though that's very irregular, but if you do need to, again, is the trustee that will fulfill that role. This is our favorite role, as most of us are lawyers, so your solicitors will essentially draft the documentation. We'll talk about some of the documents that we will draft. I won't spend a lot of time on this. Remember, I also spoke about the issuer this market is not for everybody. The issuer needs to have a certain credit standing. So you have a number of credit rating agencies in Nigeria. What the credit rating agency will do is that they will look at you and say, okay, we've looked at their books, we've looked at other loans they've taken, we've seen their cash flow. We feel that, if they raise 5 billion naira, that there's no way they will default. And obviously, this is one of those things that anybody that is investing in the bond will be looking to do. You have a reporting accountant. The reporting accountant's role is also, usually this is played by an audit firm. They will look at the historical accounts of the entity. If they need to make any projections, again, they will sort of do this. The registrar, remember I spoke about the fact that you have several issuances. You have several bondholders, pardon me, apologies. You have several bondholders that are there. So the registrar will be the one that will have a register. Now, the register doesn't need to be a physical register, but essentially they will maintain records. Remember that we also spoke about the fact that about liquidity, that the bonds would also typically be registered on an exchange, NGX or FMDQ, and people might trade them. So as the bonds are being traded, the registrar is updating their records. Then the last party we'll speak about is the receiving bank. So what essentially happens is that during the issuance process, as the funds are being raised, the funds don't go to the issuer immediately. The funds will sit in an account in a receiving bank. So maybe you appoint, say, a guaranteed trust bank, for instance. They will sit in an account in GTB. When the process is completed, then the receiving bank will release the funds to the issuer. In terms of legal, I said we're going to talk about the documentation. So remember I said that for the issuing house, you can have a shelf prospectus. This is where you're doing a program. If you're just doing a single issuance that you don't want to do a program, it's only one prospectus that will be issued. If you're doing a shelf prospectus, then if you're doing a shelf prospectus, then or a shelf program, what would happen is that anytime they want to do an issuance, a pricing supplement will be issued, and then there will be other investment or marketing material that will be done. Our role as solicitors is that there typically about three levels of solicitors. So if it's solicitor to the issue, they will draft a lot of the documentation. Your vending agreement just means that that's the agreement between the issuer and the issuing house that, look, this is what the issuing house is going to do. These are their responsibilities. This is what the issuing house is going to be paid. In terms of your master note issuance agreement, typically this is more usual when you're doing a program. So as remember, we spoke about the fact that you have a shelf prospectus and you issue a pricing supplement. So you have something that says a master document that from time to time when you want to do an issuance, the issuer then issues an instrument under it. You have a deed of undertaking. You have a deed of undertaking that essentially just speaks to the fact that, look, the issuer has certain obligations, and then obviously you have a litigation opinions, something that speaks to the fact that, look, are there any is the issuer involved in any cases that might result in a liability? So if somebody, for instance, has sued the issuer for 100 billion naira and you're issuing 50 billion naira, if they get judgment, it might just be that, oh, is the proceeds of the bond that will be used to repay the loan, which is obviously not the intention. So that is done. You have a solicitor to the trustee. So you have your program trustee. So remember, I spoke about the role of the trustee acting as on behalf of all the bondholders. So if you're doing a program, you have a program trustee, and then under it, if for every issuance, a series trustee. If you're doing a straightforward issuance, then you just have a trustee. Then you have a solicitor to the issuer who would review all those documents on behalf of the issuer. Remember, your issuer is the person that is issuing the bond itself and will draft corporate authorizations. Now, in terms of rules, I've already sort of spoken about it. The rule of the issuing house, coordinating the process, the various solicitors, what they essentially do. Okay, I'll just move to the next slide. So, okay, let me just sort of go back and round up on corporate bonds. So that's essentially your process for your corporate bonds. Now, remember I said for corporate bonds, that's when bonds are issued by corporate entities and that your bond is actually, it's a debt instrument. So essentially it's a loan. The only difference is that it's not a loan from one bank to one borrower. It's a loan from many people and instead of calling the borrower, you're calling the borrower an issuer because the issuer is issuing a bond instrument. Okay. I'm mindful of our time, but I wanted us to also just speak about sovereign bonds and subnational bonds. So a bond is a bond is a bond is a bond is a bond. So it's still a lot of what we've said applies whether it's a corporate bond or a sovereign bond. The only difference is the identity of the issuer. So if the federal government of Nigeria is issuing a bond, it's called it's a sovereign bond. Now, why would people borrow money to the federal government of Nigeria? The reason is that if you don't want to borrow money to the federal government of Nigeria, you are keeping your naira. If the federal government of Nigeria defaults on its obligations, that means your naira is not worth anything. So that means the naira is not worth anything. So if you're comfortable keeping naira, then you might as well, if you have spare cash, you might as well just give the federal government of Nigeria some small change to just sort of hold, and they pay you interest for it. Now you can have foreign currency sovereign bonds, and we talked about the euro bond. So current as at March this year, the FGN had about euro bonds of about $15 billion outstanding. And what had happened was that they had gone to issue bonds, but those bonds were not issued in Nigeria. Those bonds were issued in the international issue in the international market, and they raised those funds, and those funds were used to bulk up foreign reserves, etc. And then we also spoke about a subnational bond, which is essentially a situation whereby a state government is issuing a bond. Our laws even provide for the ability of a parastate or a local government to even issue a bond instrument. So I won't spend a lot of time on this because we can take questions. If you have any questions, just note it. Okay. So we've covered quite a bit of this already, but essentially in terms of your key considerations for issuing a bond, and a lot of this will also apply to your corporate bonds. That look, essentially people will be looking at, is it a program or a single issuance? What's the tenure of the bond? What's the interest rate? And in terms of your target investors, this target investors will be the same whether you're issuing a corporate bond or a sovereign bond. We've spoken about listing. Listing just means that, look, the process of listing it, whether on NGX or FMDQ, we've spoken about the rating process with the credit rating agency. You can begin to see that, look, virtually every single thing that a company needs to do, the federal government also needs to do. In terms of this risk are not only for sovereign bonds, they're also for all bonds. So there's always the risk that whoever you're lending money to or borrowing money to would not repay, whether it's a government or a corporate entity. There's always that risk. If it's a situation that that the entity is borrowing in foreign currency, and it's not only federal government that can borrow in foreign currency, because you can also have corporate euro bonds. There's always a risk that there's a risk that the currency might actually be devalued. There's an inflation risk and an interest rate risk. Okay, I'll just speak about it for a moment. Interest rate risk essentially means that is tied to inflation. So if, for instance, now inflation is at 3 or 4%, your interest rate is likely to be slightly higher than that. So maybe your interest rate is 4 or 5 so if your inflation is 4%, your interest rate is maybe 7 or 8%. Now if a company did an issuance for 10 years, and it happens that at the end of the second year, the country in which the issuer is operating faces significant issues, and inflation rate goes from 4% to maybe 16%. Now, what that then means is that, yes, you're getting 8%, but what you're actually getting is actually significantly below inflation. So that's just something that people that are investing in bond markets tend to keep an eye on, and that ultimately affects the yield of the bond. I won't go into the yield conversation at this point. Now, another thing just to bear in mind is that we were talking about the fact that, why? Remember, I spoke about the fact that, look, you have bond markets all over the world. Now, another reason that it's important to sort of bear it in mind is that, for instance, in Nigeria, our inflation rate is between 27 to 30%. Now, that's why if you were trying to borrow money from a bank, your borrowing cost will be so expensive, because it doesn't make sense for the bank to borrow you to lend money to you at a rate that is significantly below the inflation rate of the country, as opposed to if you were trying to do a bond issuance. Now, remember that if you're trying to do a bond issuance, a lot of times in fact, the vast majority of the time, the people that are investing in your instrument are not banks. They're not. They're people that they have a lot of spare cash, and they need to park that cash in an investment that has very, 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 very minimal risk. That's why. Target investors, I will only spend 30 seconds on this. We've already spoken about the fact that, target investors, typically your pension funds, insurance companies, collective investment schemes. Sometimes you also have banks. You also have instances where foreign investors also bring in money to come and invest in Nigerian securities as well. I won't go into the US exemption at this point in time because of time, and this applies more to a Eurobond in any way. So we spoke about key documentation for corporate bonds. You see that a lot of the things that, in fact, virtually everything that we flagged is there as well. So share prospectus, pricing supplement, trust deed, series trust deed, everything that we flag for your corporate issuance is here as well. How are we doing for time? Just keeping an eye on the time. You have your selling document is your prospectus. Depending on who was issuing it, typically there will be information on the account of the company of the issuing entity. So if it was a state government that was issuing, there will be information on the audited accounts of the state government. If it was a corporate entity, there will be information on audited accounts. One thing just to bear in mind is that if the state government is issuing a bond instrument, and if it doesn't have a law already, then the House of Assembly would need to pass an enabling law for the bond issuance and also a resolution authorizing the issuance. But I don't want us to go too in-depth into that conversation because of time. In terms of, let me just see. Okay, so this is the last slide on bond issuance, and I'll just quickly take it. Now, please remember that we've spoken about corporate bond, sovereign bond, subnational bond. But remember, I said a bond is a bond is a bond is a bond is a bond. You're trying to borrow money. You're from a certain class of people that are not banks. Now, typically in your documentation, and remember we spoke about the documentation. I'll just go back one slide. We spoke about things like trust deed, master note issuance agreement. Typically in your documentation, there are certain clauses that will be there. So you have a collective action clause that essentially says that if certain things are happening, so if, for instance, now it's clear that the issuer is going to default, there are provisions in there that will allow the bondholders to take certain steps collectively to protect themselves. You have a negative pledge. A negative pledge just means that a negative pledge has to do with security. So you can have a secured bond issuance, which means that the bond issuance is backed by security, but in most instances, bond issuances are typically not secured. So what then happens is that when you're doing your bond issuance, you do due diligence on the issue, and you check that as the issuer giving security to anybody else. If the issue hasn't given security to anybody else, then you put in a negative pledge to essentially say that during the life of the bond, so until the issuer fully repays the bond principal and interest in full, that if the issuer creates security in favor of anybody else, then immediately the same security is created in favor of the bondholders. Now, why is this an important issue? Most of us are lawyers, and you know that there's priority. So in a liquidity scenario, a secured lender would always have priority to an unsecured lender. So this is just to ensure that, look, God forbid if there was a default scenario, you are not at the back of the food chain. In terms of ranking, again, this has to do with security in a default scenario. You have provisions that talk about default, acceleration. So if it's clear that the issuer is going to default, you have things like event of default, dispute resolution provision. We're all comfortable with that. Typically, it will be Nigerian law, but if it's a Euro bond or an international bond, it will be English law. Waiver of immunity. So if a state government or a sovereign entity is issuing a bond, they will have to waive the immunity, because you don't want to lend money to a federal government and then they say that, oh, what do you mean? I'm the almighty federal government. There's nothing that you can do to me. They would have to waive their immunity to ensure that you get repaid. So that in a nutshell is essentially bonds. And just going back to it, just to a quick recollection, remember that the story about the reason why the bond market sort of evolved, because people found that it was much cheaper and to issue it, and people of a certain credit standing to multiple people, always significantly cheaper. And the different points we've spoken about, and it can be a state government, subnational, federal government, sovereign, or a corporate entity that is issuing it. Remember when we were going through the table of contents, I flagged that there were other types of debt capital market instruments. Now, another very popular DCM instrument that we do is that is issued is what is known as commercial paper. Now, remember, I may also not have made this point. One final point to make before we move to commercial paper or CP is that your bond is usually a long-term instrument. So you won't issue a bond. Remember, I was talking about the fact that it may be for 10 years, or that the federal government has even issued bonds for about 20 or 30 years. Now, a bond is usually a medium to long-term debt instrument, which means that typically you wouldn't see a bond instrument for less than 3 years. Even 3 years is slightly too short, because of the nature of the issue that is issuing it, that has a certain credit standing. The issuer can essentially say that, look, I have a very good credit rating. Therefore, rather than doing 3 years, I would like to do 5 years, and it's cheaper funds anyway. So why am I in a hurry to sort of repay? Now, the main difference between your bond instrument and your commercial paper or CP is that your commercial paper is a short-term instrument. It's a short-term debt instrument, and then commercial papers are also typically issued only by corporate entities. So you typically wouldn't see a subnational state government or federal government issuing a commercial paper. When federal government Nigeria issues short-term instrument, is known as its treasury bill, but that's not part of our curriculum for this for this session, so we'll stick to commercial paper. Now, is a short-term instrument. What do I mean by short-term instrument? Typically, the issuance would be between a period of, I think, about 27 days to about it would not extend beyond a period of 270 days. So typically, at the very maximum, it wouldn't be for more than 9 months, as opposed to a bond instrument that will typically be for 3 to 5 to 10 to 20 years. So it's typically a short-term debt. In fact, it's always a short-term debt instrument that is issued. That's the most important thing to issue. Now, similarly to a bond instrument, so where you can establish a program, you can also have a commercial paper program. The commercial paper program will be for 3 years, but even though the program is for 3 years, what would essentially happen is that the issuer in question would only issue for a limited period of time, 15 to 270 days. So the issuer may do an issuance for 6 months. And at the end of that 6 months, it would repay the principal amount. But typically, it's not for more than 9 months or 270 days. That's the technical term. Pension funds can invest in commercial paper, and as long as it's investment grade. So if it's not investment grade and investment grade from 2 credit rating agencies. So let me just explain what I mean by investment grade. Remember, I said that this market is not for anybody. It's not for the person selling pure water. It's for people that are a certain size. Now, before they come to the market, they would usually go through a credit rating exercise, and we had flagged that the credit rating agency is one of the entities that we need to bear in mind. Now the credit rating agency gives different scores. Some of those scores are investment grade rating. Some are investment grade. Some of them are below investment grade. So what this is essentially saying is that, look, the score from at least 2 credit rating agencies has to be investment grade. If it's going to be listed on FMDQ, it needs to have it needs to have investment grade from 1 credit rating agency. In terms of minimum amount, a minimum amount is 100 million naira. So this is not for someone that needs 5 million naira urgently. Minimum amount. And typically, when people even do this exercise, they usually do it for maybe about 1 or 2 billion, regardless of how small they are. Otherwise, it's not really what the exercise. Now, I'll come back to the slide on the trend. I'll just quickly speak to the meat of it. Now, we've already spoken about the fact that it's a much shorter tenure than your bond instrument. It's redeemable at maturity, which essentially means that, look, it's a lot of times it's at the back end. Now, because it's a short-term instrument, that then means that the issuance process for a bond is much quicker. Remember, I was talking about the fact that you're trying to issue a bond. It's not unusual for you to spend 6 months from when you first start thinking about it and start talking to your advisors to when you actually have the money in your account. If you're trying to do a commercial paper program, you typically, if you push it aggressively and if the books were really good, it could be done in maybe about 3 months. So a significantly shorter period of time. And if it's even an issuer that has done a previous commercial paper issuance before, and if they have all their documentation, then the issuance process can even be less than that, because the market is already comfortable with their paper. The FMDQ is already comfortable with them. They've already gone through the registration requirements, so it can be much shorter than that. Another thing to note is that, remember we were talking about the bonds, that typically only a public entity will be able to issue a bond instrument, or a public company. For a commercial paper, it can be private, it can be public. Let me just see, is there anything else we need to talk about? Some of the narrative around loans that we've spoken about for bonds also apply here. So just trying to. So in terms of the parties that are appointed, you remember I said that the issuance process for the bond is slightly simpler. Sorry, for this commercial paper is simpler and shorter than the one for the bond. So you can even see here that the number of parties that are appointed for the commercial paper issuance is significantly less, or at least is less. So you have your issuing and placing agent that I won't spend a lot of time on this. You have your rating agency, you have your collecting and paying agent, who essentially ensures that, look, when it's time to pay money to the note holders or the holders of the commercial paper, that there is no story. You have your auditor here. Then you have your issuing and placing agent, whose role is essentially to ensure the smooth operation of the transaction, and essentially, so issuing and placing that, look, essentially ensures that, look, the commercial paper is issued and is placed, and the funds get to the issuer. So when you talk about funds, the inflow of funds from, so the inflow of funds to the issuer is in issuing and placing agent. When you talk about inflow of funds to the repayment, is more collecting and paying agent. We also have a slide. This is just essentially just talking about documentation. Once again, you can see that the documents are necessarily not as many as what you have for your bond issuance program. So you have your program memorandum, you have a pricing supplement if it was under an issuance, depending on you. So you can have an issuing and placing agency agreement. Remember, we were saying that your issuing and placing agent, the responsibility is to ensure that the funding that the issuer is looking for gets to the hand of the issuer. So it's the issuing and placing agency agreement that regulates that relationship between the issuer, what the issuing and placing agent needs to do. You can also, it's not here, but you would also have a collecting and paying agency agreement, essentially, that talks about repayment. Typically, this would be someone with a banking license to ensure that there are no stories. You'd have a deed of covenant, essentially, that would spell out all the covenants and all the obligations that the issuer is making available to the note holders. And then you have a legal opinion that will be issued by the solicitor that is acting on behalf of the issuer. I'll just go back 2 slides to talk about the trends. Now, what we found out, what this slide, and just be slightly patient with me, just be patient with me for a moment. This slide talks about number of issuances, so it doesn't talk about the amount that has been issued in absolute terms, but you can sort of see, it doesn't go to 2023, but you can sort of see in terms of red is your commercial paper, and you can see that, and this is number of issuances. You can see the number of people that have come to the market and how many times they've issued, even in 2022. In 2023, it may have remained flat, but you can see the difference between that and your corporate bonds, which between 2018 and 2022, you've seen just a marginal increase. And I suspect that 2023 might be somewhere around here. And then your federal government and subnational bonds, that in terms of the number of issuances that you've had. Now, you remember I said that this is in terms of securities that have been admitted, or number of issuances that have been made. This doesn't speak as to the actual amount that has been raised. If and we unfortunately don't have a slide for that. If you have something that speaks to actual amount that has been raised, then you might have to flip this around, because one of the biggest borrowers in the Nigerian debt capital market is, of course, the federal government of Nigeria, and then followed by corporate bonds, and then followed by your commercial paper issuances. So just to sort of flag that. And then I believe the last thing we wanted to talk about was in terms of private placement. I've tried to rush through as quickly as possible so that we can have, and I can see we already have about 15 questions already. So I'll try and rush through the slide so we can have time for questions. You can also have, remember I made the point that at the point you're issuing your bonds, when you're issuing your bonds, it's done publicly. Remember, I made that point. For your commercial paper, and when I say done publicly, it's done by a public company. For your commercial paper, it can be done by a public and private entity, but the issuance process is slightly different. Now, you can have the market has also evolved to an extent that you have what is called PPN, or private placement notes. Essentially, the FMDQ has rules around it. Now, what do the PPN rules say? The PPN rules essentially is a framework that enables someone that is a private company to issue bonds. Now, remember we spoke about section 22 of CAMA, that a private entity can issue bonds publicly. So, which is why you see that the caption here is private placement. The issuance has to be done on a private basis to identify the investors. So, yes, the Investment and Securities Act speaks about the fact that only public companies can issue public instruments, but there are exemptions as to what can be done, and what the private placement note or slash bond issuance process has done is to take advantage of those exemptions. So essentially, what will happen is that advisors it's not as many securities are not issued under here as you would have when the federal government of Nigeria, or subnational or corporate or CPs are issued. So we only have one slide on this, just to sort of flag it for for attention of colleagues, esteemed colleagues on the call. So essentially, you would have an issuer that is a private company. That private company, and remember over here, a big point for bonds and CPs was that you had a credit rating. Over here, you can see there's no credit rating. So this is essentially a window that allows slightly smaller companies that haven't reached the stage whereby maybe they can issue bonds or commercial paper to at least be able to raise finance in the capital market. So the private placement note essentially says that, look, if you're trying to raise those funds, whether it's bonds or notes, notes is another word for commercial paper. Notes used here just means it's short-term instrument. So they can sort of come to the market, but it's not going to be issued publicly. For something like this, for something like this, typically pension funds a lot of times may not be able to invest in it unless they have a certain credit rating. But a lot of people that even participate here, they don't even bother with the credit rating, because they just say, look, what I'm trying to raise is so minute, so small. So for your CPs, issuance size will typically be from about 2 billion naira upwards for commercial paper. For your bond issuance size will typically be from about 5 billion naira upwards. For something like this, they can be as little and as small as maybe a couple of 100 million. So maybe 250 million naira, 500 million naira. So it's a much smaller issuance process. They will come to the market and they will take the relevant selling documents, in this case, the placement memorandum, and they will issue it they will market it on a private basis. When I say market on a private basis, that just means that, look, if I want to, so if I was being approached, someone would take the documentation and would send it to me directly, and they would say, look, this is what we want to do, and they will meet with me, and I would let them know, oh, remember our 2 million naira, my 2 million naira, I want to put it here, or it's something that it's a market, or I'm not interested in this particular issuance. And then you similar to it, you have your trust deed, you have your vending. Remember, we said your vending is essentially what regulates your issuing house / financial advisor and the issuer. And we spoke, you can have private placement, but if a public company is trying to do a private placement, then typically they will require SEC approval. But in this sort of instance, in this market, a lot of times the issuances are usually done by, they're small issuances that are usually done by private companies. same tax considerations. So when we say tax considerations, if interest is being paid, withholding tax will be paid on the interest. If there's an obligation to pay VAT, then you have that obligation to pay VAT. That's the last slide. I'm going to just try and that's the last slide. I'm just going to go to the beginning of our presentation, and I would now try and take questions. And I'll try and go through as many questions. I'm not sure if there's an opportunity to mute or for participants to unmute, but I would try and I would look for guidance to the CMSA team or an MBA team, but I'll try and take some questions. Okay, so perhaps maybe let me stop sharing and then stop sharing. Okay, and try and take some questions. Sorry.
Thank you very much.
The first question.
Thank you very much, Sunday. That was quite very insightful. We have a lot of thank you comments here from our colleagues. Uchechi Anyanele says, thank you for the clarity with which you teach us. We have questions on the Q&A, and we also have questions from the chat. We've sent them to please share these questions here so that it's easy for us to track them. But yes, please, if you want us to read the questions, if you want to go through them, whichever way works for you, we're flexible. Thank you very much.
Okay, thank you very much. Let me try and take, because of time, let me try and take maybe the first 5 or 6. I suspect that some people will also have put questions in the chat room, so I'm not able to go to the chat room. But let me try and go to the questions in the Q&A. So the first question is, why are zero coupon bonds issued when there is no interest payable? Let me try. So interest is payable. It's not that interest is not payable, and one point I hadn't talked on, the expression coupon. Coupon is just a technical term for interest. So when the question is why do you have zero interest rates? Interest is payable. I'll try and use the scenario. Let me use our young lawyer who has managed to save 2 million naira and wants to invest in. I wants to invest in. Sorry. And sorry, I have a colleague here that needs to exit. Sorry, apologies about that. So let me use that 2 million naira scenario. Someone is let me use 10 million naira. So let's use amounts that we're comfortable with. So MTN is trying to raise 1 billion. That's not that you are not really interested in how much they're trying to raise. Your concern is you have 10 million, or you have 1 million naira. You have 1 million naira that you've saved. You want to invest it in it, and you want to know how much they're going to pay you. Now, what would happen is that in an ideal scenario, in a typical bond scenario, MTN will come to the market and they will say that, look, we will pay you 10% interest. So that means that over the life of the bond, each year they're going to pay you for each 1 million naira you invest. They are going to get 100,000 naira. I believe that is clear to all of us. Now, but it's a flip side for the zero coupon bond. So let's assume that it was a short-term instrument. So what MTN will do is that they will give you a bond set. They would in their books they will record that you've invested 1 million naira, but they will only take 900,000 naira from you. So remember, you have 1 million naira to invest. But you're investing in a zero coupon instrument. So they take 900,000 naira from you. You have that 100,000, you've gotten your interest upfront. So that then means that for the life of the bond, you're not getting any interest, because remember, you've gotten your interest upfront. When it's time for them to pay principal at the end of the bond, they will pay you 1 million naira. I don't know if that sounds. Remember they've taken 900,000 naira from you, but they're paying you 1 million naira, and the bond certificate that they're giving you will show that you invested 1 million naira, even though you only invested 900,000. I hope that is clear. If it's not clear, whoever sent Messi should please answer. Should please send another chat. Next question is that, good day, please. What are the criteria for a corporate body to issue bonds? I think I try to sort of speak. I try to sort of speak to that. So the most important thing is that if it's a private company, then and they want to issue bonds, then they might need to incorporate an SPV that is a PLC. If it's a PLC, they can go ahead and issue the bond. That's number one. But number two, the most important thing is that they need to have a certain credit rating. You understand? And so you have certain credit rating agencies that are in the market. And the credit rating agency will also be looking to rate your that essentially. So your credit rating agency they will go through your accounts maybe for the last 5 years. They will go through your projections. How much has come in? Have you borrowed money? What are the things you've done? As long as you can meet their requirements, they will give you an investment grade rating. If you can get an investment grade rating, every other thing you can sort of walk around. You understand? But that's another thing. And then obviously for your bond issuance, you need to get regulatory approval. So your SEC process. And I think so this question may have been, I see it was slightly earlier in the process, and hopefully I had answered it later on. Third question, what I'm going to do is I'll try and do this for 10 minutes. And then any questions I haven't taken, I'll ask Simi to just jump in and take us, or someone else to just take. Sorry. Thank you for the clarity. With the record of government borrowing. Okay, so someone has said, are sovereign bonds truly secure investments? Well, the only thing I'll tell you is that I believe that they are secure investments. Look, the fact, if you haven't jackpot, if you are living in Nigeria today, then you've already answered your question. So Uchechi, for as long as you are in Nigeria, if an investment by the federal government of Nigeria is a secure investment. Because why do I say that question? You are in Nigeria, that means you are saving in Naira. Agreed? That means that you are working, you are earning Naira. Now, God forbid, if the federal government of Nigeria defaulted on their obligations, our Naira will become worthless. So think about a Zimbabwe type scenario, and I know all of us have seen those memes in which they show that, somebody is holding 100 billion Zimbabwean dollars because the money is ultimately worthless. So the fact that all of us are here and even listening, having this exercise shows that the federal sovereign bonds are their secure investments. And remember, your sovereign bond is your last issuer. So think about it. If the federal government of Nigeria defaulted, that means that all of our banks that are holding Naira, well, you can sort of fill in the blanks there. Can a government parastatal, or does it? A government parastatal can issue bonds independently, but it's not that. The truth is that it's not that straightforward. Yes, technically they can issue it independently. So they can a government parastatal can issue it. So NNPC, for instance, NNPC is now private, but even when they were a quote unquote government parastatal, they could have issued a bond, and there are times that even NNPC even borrowed. And they did a borrowing program from banks, so they can issue it. But people are also slightly. So going back to Ichichi's point, people are slightly distrustful of government. So what essentially happens is that when I'll answer it in a roundabout way. So when a state government is coming to the market, people are comfortable with federal government because they print your money. So if you say that federal government hasn't paid your money, CBN will go to their printer and they will print money and they will give you your money. You understand? What that does to the economy is a slightly different conversation. So people are comfortable borrowing, lending money to the federal government. For the state government, people don't really want to hear story. So there's something called an ISPO. We didn't want to go too in depth, but essentially what happens when a state government is coming to the market is that they need to issue an ISPO, which essentially means that the Commissioner of Finance will write a letter to the Minister of Finance of the Federation. All of us are aware of what is known as FAC, Federal Allocation Committee. At the end of every month, commissioners of finance meet they don't share money, but they essentially agree that, look, they're distributing 1 trillion. This is how much is going to each state. Now, what happens is that that state would write an application to the Ministry of Finance saying that I would like to borrow X billion naira from the market. When I borrow this money, each month that this instrument is outstanding, and then people will compute it. Oh, they're doing a borrowing program of say 20 billion. Over a 5-year period, they would need to pay maybe 250 million naira. I'm just using big. So that means for each month, before the money even gets to the hand of the federal government, 250 million goes straight into an account. It's sitting there. So it sort of goes there. Now, I'm answering this for the parastatal. Now, depending on the parastatal, now if people go through that level of stress for a state government, if it's just any parastatal, they can say they want to raise money, but people may not necessarily answer them. Someone says I'm too fast. We only have 2 hours. That's if there's anything that is not clear, please let me know. Difference between a trust deed and a series trust deed. I try to sort of speak to this. You can have so for your trust, because I've been told I was going too fast, I'll try and slow down. So remember, we were talking about the fact that if you're doing your CP or your bond issuance, you can have a program. What's the advantage of a program? A program essentially means that you establish I'm looking for another word for program. You establish something, which is essentially a program that says, look, I have a program for 10 billion, and that is valid for, say, 3 years. In that, anytime you want to raise money, just quickly go, okay, I want to raise 500 million. You go and raise it. And the reason this is important, particularly for bond issuance, is that bonds take a lot of time to issue. So if you don't have a program, every time you want to issue a bond, maybe you spend another 6 months, then you spend another 6 months, as opposed to establishing a program which might take you 7 or 8 months, but then you can do several issuances. Another advantage of setting up so in a situation where you then set up a program, you have what is known as a program trust deed. When you have a program trust deed, then for every issuance, you understand. So for your 500 million, there will be a trust deed that accompanies it that says, oh, for this 500 million, this is the trust deed saying that there is no story. This is the account. This is where the money will go. I'm acting on behalf of XYZ people. But if it's a straight issuance that is not a program, then you can use only a trust deed. Hopefully that is clear. Someone asked about a bond and a debenture. A debenture can be used in different senses, but I think in the sense that you're using it, a debenture is essentially also, it's similar. So it's also a debt capital market instrument. That's the easiest way to sort of think about it. There are slight technical differences that I won't speak about. Debenture typically might also have a more secured element. So it might have security sort of attached to it. Someone is asking for the slides. We will share it with CMSA after the session, and they have everyone's email. They would send it to everyone. So that's essentially the main difference, but they're very, very similar. And remember, at the beginning of the presentation, I gave the example, and I said that, look, take a step backwards and just sort of think about it, that as opposed to you going to a bank to borrow money, you're essentially telling your guys that, look, guys, I would like to go into this business. So your family is giving you certain money, your friends are giving you, people that essentially trust you are essentially giving you smaller bits of money. Yes, what they give you might be significantly less than what you'll get from the bank, but you have a bit more flexibility on it. Someone is asking that, is the principal paid back monthly or annually? Typically, the principal will be paid back on a quarterly basis, so it won't be paid back on a monthly basis. This is a slightly sophisticated market, so people are comfortable receiving interest and principal on a quarterly basis, or even in certain instances on a semi-annual basis. That means every 6 months. So typically what you will get is quarterly or semi-annually. Someone has asked me to speak about, okay, there are 2 questions about infrastructure. Okay, it's the same person, about infrastructure bonds. I will speak about infrastructure bonds at the end, when I finish. Let me just try and go through okay, so The same person has asked 3 questions. Infrastructure, infrastructure fund setting up. Okay. Okay, so I think the question is on infrastructure fund, because this session is really on bonds. I won't go into it. Merit, if you want me to speak about infrastructure bonds, I'm more than happy to sort of go into that, but I don't want to digress. It's a lot of information to take in over a short period of time. Someone has asked that, does this mean that issuances that use the book building process are floating rate bonds? Well, not necessarily. Not necessarily. It ultimately depends on what you're trying to do. So I didn't want to go into this, but someone has asked me to explain floating rate. So I'll start by explaining the floating rate. Now, the fixed rate is very, very easy to explain. That, look, I come to you and I tell you that, guys, so right now on this call, there are about 404. There are 404 participants. So I come to you and I say, guys, I have this business idea. You guys trust me. You've been listening to me for the last 1.5 hours. I'm credible for this money. But these are our banks. They want to kill me. I have this great business idea. Can everybody on this call just give me 100,000 naira? I will put account details and I will return your money to you. CMSA can vouch for me. You understand? That's and I tell you that, look, for that 100,000, I'll return it after 1 year, and for it, I'll pay you, say, 20%. So I'll pay everybody back 120,000 at the end of the 1 year. That's your fixed rate. That's your fixed rate. Some people are exiting now that I'm talking about getting money from them. That's your fixed rate scenario. Now, your floating rate scenario is essentially a situation whereby it's not a fixed rate. So the interest rate is tied to a particular event. Now, in order to explain, perhaps these are all tied to things like inflation. Remember, I was talking about the risk of inflation. Because there's a lot of information, I had to go very fast. Otherwise, we wouldn't have covered the topic. So remember, we said that in Nigeria right now, your inflation rate is about 30%. So if, for instance, I'd invested in a 10-year instrument about 4 years ago, I'm already out of money because whatever interest I'm earning is far below inflation. So what people try and do is that they may, for instance, say, look, the Nigerian Bureau of Statistics releases information on inflation rate. For this instrument that you want to raise, we don't trust you, or we trust you, but we don't trust the market you are in. So you know what? Guess what? They will tie your interest rate to inflation. So they will say, oh, inflation minus 5%, or inflation plus 1%, in order to essentially be bridge for inflation. So that's your floating interest rate. Or they may tie it. And I also spoke about the fact that CBN has monetary policy rate. They watch the market and they say, okay, this is the MPR for this period, and they may change it. So I say, oh, this is the monetary policy rate. A lot of times is determined by things like, again, your inflation rate. So I say, oh, my monetary policy rate, if, for instance, monetary policy rate is 17%, I say, okay, monetary policy rate plus 5%. What that does is that, God forbid, if inflation in Nigeria goes to 50%, you understand, very, very quickly, it's very simple. Or say that the monetary policy rate goes to 50%, my interest rate is 55%. If monetary policy rate goes to 5%, my interest rate will be 10%. But remember that the monetary policy rate is released by the monetary authority, in our own instance, the Central Bank of Nigeria. So the Central Bank of Nigeria would look at the market very well. They won't say, out of spite, bring down the monetary policy rate, because they know that they need to be credible. So that's I hope I've tried to explain floating interest rate better. In terms of your book building process, so what typically happens is that after I've gotten my regulatory approvals, I will then, particularly for sophisticated issuances, I will then approach pension funds. I'll have been talking to them, and I then essentially tell them that, guys, this is the instrument, this is my credit rating, I've met all your eyes and all that. Now, you then book building is then a process whereby the different potential bondholders or investors would then say that, you know what, we like this your instrument too. Would like somebody may quote 15, somebody may quote 10, somebody may quote 5, somebody may quote 4. Now, somebody may quote 20. Now, depending on how much I'm trying to raise, I'll then do sort of like a median rate. Do you understand? And I'll then say that, look, I'm trying to raise this amount of money. So I'm then essentially at this rate. Now, what that does is that for people that have quoted below, if it's fixed interest, I essentially they get an increment, because if, for instance, someone was willing to invest in my instrument at 12%, but it's only one person, and I'm trying to raise, say, 10 billion, but that person is only bringing 100 million naira to the table, that doesn't really help me. You understand? So one person is ready to invest at 12%. The rest of the people that maybe are ready to put in about 8 billion are ready to maybe do 16%. And then you have people that are maybe willing to put in additional, say, maybe 20%. So maybe I'll then take a median rate and I then say that, look, you know what, my cutoff rate will be 16%. So I'll take the money of the people that are doing bringing 8 billion, and together with the 100 million naira, and I say, look, I've raised 8.1 billion naira. I've raised 8.1 billion naira. I've tried to explain in a slightly simplistic manner because there are many of us on this call, but I hope I have been clear. So I'm just going to take about 2 or 3 more questions before I let Simi also read questions from the chat room. So someone is asking about disputes around this. This is actually a very interesting question. Someone is asking about how are disputes that arise from sovereign bond issuances. Remember that sovereign bond issuances is essentially that, look, you have a government entity that is issuing an instrument. That how are those disputes resolved? So you have an instance whereby, so I'll give you a practical scenario. Federal government of Nigeria has raised money. So maybe they've raised 100 billion naira, and but they've raised 100 billion naira. They've then decided for one reason or another that it's too hard to be repaying this money. And we've seen instances. So, for instance, in Ghana, a few months ago, the Ghanaian government was talking about the fact that we're not sure we can really pay all this money that we've borrowed, in spite of the fact that they willingly borrow the money. So those of us that are lawyers automatically know that that's the dispute now. So the question now is that if you're fighting with the federal government of Nigeria, who is going to resolve the dispute? So obviously you will go to the court. Now, a lot of instances, if it's I'll use the Ghana scenario. In the Ghana scenario, they wanted to default both on their local obligations, which was to their local pension funds, and also to their foreign bond obligations. Now, the local bond obligations was very simple because most of us on this call, you have retirement savings account, that you have a PFA account. Is our money that our pension funds are lent to the federal government of that country. If they default on it, it directly impacts us. So if the government is not careful, they might lose the next election. So first of all, let's even start from there. Now, if it's a local issuance, it will obviously go to court and all that, and you'll go through the court process. The more interesting one is that when it's an international issuance. Now, if it's an international issuance, what that then means is that you've blacklisted yourself, because until you resolve that issue, nobody is ever going to borrow your money. You understand? So so that automatically means, so that means that investors. So and I know the question was about disputes. I'm speaking about the soft points before the hard points first of all. So that means that international investors that want to invest in your country would say, these people are not trustworthy. I don't trust them with my money. They won't invest in your money. Those that are a resident will take money out. That means that even lenders of last resort, people like World Bank or IMF, they won't borrow you money. So that means that your economy now starts to tank because everybody is taking their money out. And if everybody takes their money out at once, and you're already in a default scenario, ultimately it impacts on it. Now, if it's also an international issuance, which that's why you see that for Euro bonds, it's typically always English law. It would either be arbitration or it will be a resolution of disputes will be in courts of UK or courts of England. And of course, if you've defaulted on your obligations, very easily, a high court judge in the UK will be very happy to make a quick ruling after I haven't had anybody saying you've defaulted. At that point in time, the trustees will then start looking for your assets. So if you have if the government has an airline or foreign assets abroad. So that's is a carrot and stick situation that is not like anybody will go to war against the sovereign, but there are things that there are levers that ensure that the sovereign doesn't behave badly. Hope I've answered the question. What role does a trustee play in a commercial paper transaction? It's very similar. It's exactly the same role. The trustee is in the transaction for only one reason and one reason alone, which is essentially that you have so many bond holders or note holders in the case of CPs that, so if for instance, you've raised money and about 100 people have invested, it's very easy for me, to just ignore them. But when they all have someone acting on their behalf, that is called a trustee. Now, the trustee is appointed by the trustee, and the trustee will place many obligations on the issuer. That is what the issuer can do. This is what the issuer cannot do. This is when funding needs to go into the account. So there will be a designated account from which bond holders or note holders will be paid. So essentially, it's a very similar role that the trustee will play in a commercial paper transaction. Now, there are certain instances because a CP transaction is excuse me. Because the CP transaction is a short-term transaction, in many instances, they might not take a step to appoint a trustee. You understand? Because the CP, they might take a view that, it's typically is not more than, so it can be from 15 days to 9 months. In 15 days to 9 months, if Access Bank is doing a commercial paper, they should be able to pay back my money within that period of time. So you understand, but in spite of that, you still have someone. So you have you will still have a party appointed who is responsible for seeing that those funds are paid. I'm trying not to go through too in depth, so I don't lose people. Difference between CP and bonds, we've spoken about it. So a commercial paper, easiest way to think about it is very short term. It's not more than 9 months. Another thing to also note about is CP is not more than 9 months. Bonds is usually from 3 months upwards, and I think I spoke about that. Another thing to also note is that for your bonds, typically you will need SEC approval unless it's issued on a private basis, and I think we'll cover that in the last slide. But 99.9% of the time, you're doing a bond issuance, you need the approval of the SEC. And it's actually that approval of the SEC that takes time. Now, there's an exemption. At least there currently is. There's an exemption in the SEC rules that say if you are issuing an instrument that is less than 270 days, that you don't need to get approval of the SEC. That's the main reason that your CP transaction is. So that's why people are forced to issue within that period of time, because once you start issuing it for a long period of time, I need to go to the SEC. Then you may as well, it doesn't make sense to go and spend 6 months getting approval for an issuance that would not be longer than 9 months. You sort of see where I'm going. Interest rate risk will affect. Interest rate risk is unlikely to affect floating rate bonds, but it will, depending on how the interest rate goes. If interest rate goes up, and in a market like Nigeria, interest rates tend to go up most of the time and not go down. So it would, in that instance, it would affect people that are investing in fixed rate bonds. And because the issuers also know this, the issuer obviously wants to only issue a fixed rate bond. You understand? So think about it. If you are going to take a car loan from a Nigerian bank, it's in your interest to ensure that it's a fixed interest rate. once it's a floating interest rate, once anything happens like this, they increase it, they increase it, they increase it, which happens a lot of times. Rules for private placement. There are specific regulations that deal with private placements. I believe the FMDQ has issued rules around it. Please check on the FMDQ website. Another thing just to flag is that if this is of interest to you, is something you really, really like, there's a lot of information on the FMDQ website. In fact, FMDQ, they've just decided that, look, they were going to democratize this process. So there's a lot of information, there's a lot of material, there are presentations, there are KYCs, there are all sorts of things that if this is something you're really interested in, that you could spend hours and hours and hours on end to just sort of going on their website and just finding that information. For the person asking about rules applicable to private placement, I believe FMDQ has rules, and I'm sure it's on their website. Yes, private companies can no, you can only. So someone is asking, can private companies issue public placement? No, it's the other way around. So if it's a bond issue, if it's a bond issuance, then they wouldn't be able to issue a bond issuance program. Remember, I said that during the course of our presentation that when a private company wants to issue a bond, it needs to incorporate an SPV that is a public company. A certificate for this, that is a CMSA response. Underwriters are, so many years ago, about 15 years ago, someone is asking a question about underwriting. So underwriting is essentially a process whereby the investment bankers essentially guarantee. So if I have a company, I come to the market and I say that I would like to raise, once again, 10 billion naira. But I'm not sure if people are going to like my face. So I pay an additional amount of money to some banks, and those banks say, look, okay, you know what? We have your back. Just come to market. When you come to market, so maybe I have 2 underwriters. They say, look, we would we'll underwrite it for a minimum amount, and you pay us X amount. That then takes stress off me because I know that it would always be that my issuance will always be successful. But the market has sort of moved away from the underwriting element. And no, you typically CP issuances are not underwritten. In fact, most issuances are not underwritten. There are ways that people go around it by sort of tying fees of issuing houses to how much they're able to raise, but that is not underwriting. No, a credit rating agent is not similar to the role of an auditor. An auditor is a big four. So KPMG, PwC, Deloitte, EY. Your auditor looks at your account at the end of each financial year, and together with the board, they prepare your audited financial statements. For your credit rating, a credit rating is something that you do because you're trying to do an issuance. So your credit rating is, I think there's GCL, there's Augusto and Co. I've forgotten the name of the last credit rating agency that we have in our market. But what they essentially do is that they will look at your accounts, they will look at your projections, and they're essentially looking into the future. So the best way to answer it is accounts are historical. So think about it. Think about it this way: accounts are historical. So if I've done business over the course of the 2023 financial year, and my year end is December 31st. So that then means that when my auditors go in, my auditors will go in 2024. They are looking into my books for 2023. So accounts are historical. Now, your credit rating process is more forward-looking. Your credit rating agency is looking at your historicals. They are looking at your projections, and they're essentially issuing a report saying that, look, we've seen everything about Mr. Yetunde, and we think that is good for the money. Therefore, we'll give him a star, and we recommend that everybody on this call can borrow him 1 million naira if you have the money. That's what your credit rating process does. So it's slightly different. Mr. Peter Cole, I don't really whether they are. I don't really understand the question. The question is about bridge financing. Mr. Peter Cole, could you please clarify your question? I don't really understand it. Question here about Series Trust Deed. Okay, must be prepared. So someone is asking about series trust deed. The easiest way to think about it is that you have a program. For each issuance under that program, you have a series trust deed. Now, why is it important? Okay, maybe I should have, maybe it was my fault. Maybe I didn't take enough time to speak about it. Now, I'll take a step backwards and let's assume that we're back in our presentation. Now we're on the slide that is talking to program. Remember, you are establishing a program. Now, why are you establishing a program? So that you can issue very, very quickly without having to take time to issue it. So I've established a program of, say, 100 billion naira. But remember that under that program, even though my program is 100 billion naira, I'm not going to issue the 100 billion naira at the same time. Do you understand? Today I might issue 5 billion. In 4 months' time, I might issue 10 billion. In 18 months' time, I might issue 15 billion, depending on what I'm trying to do and how I need the money. Now, because I'm doing the issuance at different times, remember also that financial conditions change from time to time. So if I try to issue, say, 5 billion naira, December 5, 2022, the interest rate that I will get 1 year ago would not be the interest rate that I will get this year. It will not be the interest rate that I will get December 5, 2024 or December 5, 2025. You sort of see where I'm going. Now, the reason the series trust deed is important is that, first of all, yes, the trustee will tell me that, and typically it's the same trustee, the trustee will tell me that, look, Oga, we know that you have a program, but yesterday you issued 4 billion. Therefore, I need to do a series trust deed, noting that you've issued 4 billion and the interest rate for that 4 billion was 15.5%. If I come next week and I say I want to issue another 10 billion, the interest rate for that 10 billion might be 17%. So they'll say, look, we need to do series trust deed for issuance 2 under the program trust deed of Mr. Yetunde of 17.7%. So there are certain things that will change and there are certain elements that will sort of change. That's why you have a series trust deed. Hopefully I've tried to clarify the question and answer it, Mr. Obadima. So someone is asking, what are the remedial processes? If you have a default in the corporate bonds, there are quite a few things you can do. So first of all, the trustee typically won't allow you to even get there. So one of the things that you can, even before you go to court, and I know that there is a long dispute resolution mechanism, but before you even go to court, remember that there is a regulator for the Nigerian capital market called the Securities and Exchange Commission. Section 13 of the ISA says that one of the core responsibilities of the Nigerian SEC is to protect investors. So if somebody has taken money and they're not repaying it, first of all, you want to report them to the person that can deal with them. You want to report them to the regulator. The trustee can also take certain steps. So even before you sort of go to court, there are certain steps that can be taken to sort of ensure that it doesn't get to that. And the reason that it is important is that, think of it like dominoes. So the market has been built up over time. So about 15 years ago, the corporate bond market in Nigeria was essentially almost comatose. It was only the federal government of Nigeria that was issuing instruments, and a lot of work went in to getting it to this place. Now, having gone through all that hard work and everything, the people that are stakeholders are not just going to fold their hands and sleep and allow 1 or 2 corporate issuers to issue it. Because what will happen is that if this corporate issuer defaults today, another one defaults next week, another one defaults 2 weeks from time, guess what will happen is that when future people want to come, people will say, wait, we're not investing in this, and it will kill the market. So there's a lot of incentive to ensure that things like that don't happen, and a lot of work goes into it. So I've thrown around figures, 100 billion, 5 billion. Before you can issue that 5 billion, you will sweat. Do you understand? So even apart from the work that we'll do, they will stress you, they will check it, they will check everything to ensure that you can issue it, which is why I said that this market is not for everybody. It's not for just anybody that just feels you can just raise money and just disappear overnight. Something about currency risk. The currency risk is more that applies more to if we've issued bonds to our euro bonds, and I believe that federal government of Nigeria is trying to take steps to address that which is in terms of our foreign reserves. And the federal government of Nigeria said, regardless of how much it is, whether we borrowed 50 trillion in the past, when the time is right, we will pay it. They've said that over and over again. Quarterly and semi-annual interest rate applies to both bonds and CPs. I'm going to. So I've tried to answer. There are a few questions I haven't answered, but I think some of them I've answered in passing. I'll just, and I've taken much more time than I wanted to. I'll hand over to our facilitators just to check if there are any questions that I've either missed in the Q&A, or if there are any questions in the chat box. So if it's possible to unmute anybody to ask, I'll hand over to you, Simi. Okay. Just wait. Okay, maybe I'll.
It appears Simi is.
Yes.
Okay, Simi, are you there?
Yes, I am.
All right.
Thank you very much for that session. On behalf of the NBA's Institute of Continuing Legal Education, the CMSA, the executive members, and the executive committee of the CMSA, we want to deeply, deeply thank you for a very practical, comprehensive, and detailed session. We must also thank you for your patience in running through all the questions as much as you could. And we understand that this is a very busy period for lawyers, but despite it all, you graciously accepted our invitation to share your knowledge and experience of the market with all our participants today. And for that, we're deeply, deeply, deeply grateful. I would also want to thank all the participants that have joined us today for today's session from start to finish, for your patience and for ensuring that this session has been most engaging. Again, we want to say thank you. And to all participants, we also want to remind you that the session continues tomorrow. They're having the third session tomorrow, and it's going to start at 2. For those that have not registered, please endeavor to do so. Again, I want to thank you, Mr. Ayotunde. I want to thank all the participants for being a part of this session.
Thank you.
And so on that note, we have come to the end of today's session, and we look forward to seeing you all tomorrow again. Have a wonderful evening.
Thank you. Thank you, everyone.
You're welcome. Thank you.